Hey everyone, Nolan Solano here, and I'm back with this week's mortgage market update. It's been a surprise for many to watch interest rates climb after the Federal Reserve's initial cut nearly a month ago. There are some important factors behind all of that I'd like to share, so let's dive right in. First up, let's talk a little bit about inflation. In September, inflation came in a bit hotter than expected. Consumer prices rose 2.4% year over year, which is still progress towards the 2% target the Fed has, but not as much as we'd hoped. However, within the most recent CPI report, there was some good news. Shelter costs, which make up nearly 46% of core inflation, are starting to soften. That's critical because of its weighting. So lower shelter costs could really help bring inflation down in the months ahead. We're moving in the right direction, albeit slowly. If we annualize the last 3 months of inflation readings, we'd actually be closer to the Fed's target at 2.1% right now for headline inflation. Progress is being made. Jobs. We certainly got worked over by the jobs report at the turn of the month. The Bureau of Labor Statistics, or BLS, reported that there were 254,000 jobs created in September, which was much stronger than estimates of 140,000. Making the report stronger were upward revisions to the previous 2 months. This seems to indicate that the jobs market remains robust. However, last week's initial jobless claims hit a 14-month high, with 258,000 people filing for unemployment benefits. Part of that spike was due to the hurricane, so it's important to keep that in mind. What's more telling is that continuing claims, the number of people still receiving unemployment, have been above 1.8 million since June. This suggests that companies are slowing down their hiring, making it tougher for people to find new jobs. On a brighter note, home values continue to grow. Nationally, they rose 0.12% in August and are up 3% year over year, according to ICE, despite elevated mortgage rates. Other indices like Case-Shiller and the Federal Housing Finance Agency are also reporting strong gains, with some showing prices up as much as 5% from last year. Now, homeownership remains a fantastic investment for building long-term wealth. Bottom line, mortgage rates will continue to be reactive to the direction of overall inflation in the economy, and not so much by potential rate cuts by the Federal Reserve, as they can only have influence over very short-term borrowing. Those holding out to see an interest rate with a 4 handle will again likely be waiting for quite some time, as home prices continue to rise in the meantime as a result of supply issues. The Federal Housing Finance Agency and Mortgage Bankers Association recently released their forecast for 2025, predicting a 30-year fixed rate of 5.8% by the end of next year, so not much lower than current levels. Well, that's what I have for you today. Thanks for tuning in. If you have any questions about the market, mortgage rates, or how this affects your home buying or refinancing decisions, feel free to reach out. I'm always here to help. Until next time, take care and stay financially savvy, my friends. Everyone.